Welcome to the Sand to Pearls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for July 23rd, 2017. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.54 rose from 1.35 last week, continuing within bullish territory. The total count of securities in bullish or bearish patterns increased 1% to 2,854. The count of bearish stocks decreased 6%, while the count of stocks in bullish patterns increased 7%. The Sand to Pearls PNF Market Breadth Summary Chart shows us a market now 8 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To subscribe to the weekly Sand to Pearls Stock Market Commentary via email, free of charge, simply enter your email address in the space provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 75 points for the ninth advance in 13 weeks. At a positive 240.49 points, it has risen above the February 2015 top and continues below the 5 remaining tops above plus 100, and it continues above all 4 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 4 accumulation days and 0 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on higher average daily volume. Momentum. The CCI 20 daily is now at a positive 123.59, down from a positive 151.22 last week. At Wednesday, 7/19 close, the CCI 20 daily had 6 consecutive days above zero for a change in Woody's trend to up. We wait for the CCI 20 daily to return to the plus or minus 50 range for another zero line reject entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 64 weeks ago, while the daily CCI 20 began a Woody's uptrend this past week. The CCI 20 weekly has risen to a positive 132.81, up from a positive 99.51 last week. We await the return of the CCI 20 weekly to the plus or minus 50 range for another CCI 20 weekly trade. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and only 2 of the bottom 5 are negative. Summary: some tech, gold and silver, and oil services on top. Oil, brokers, and banks on the bottom. Bullish, computer hardware, and comp tech continue in the top 5. Disk drives have entered the top 5. Oil has entered the bottom 5. REITs have left the bottom 5. Bearish, gold and silver continues in the top 5. KBW Bank and brokers have entered the bottom 5. Focus this week from www.zerohedge.com. Market paralysis confirmed. Squeezed shorts and anxious longs are fleeing stocks. The following are some key points and charts. For the last 2 years, short interest in the U.S. stock market's largest ETF has collapsed as bears have been squeezed back to their lowest level of negativity since Q2 2007, the prior peak in the S&P. But there's a bigger issue. Despite record highs and no-brainer dip buying, anxious longs have dumped the S&P ETF holdings for 4 straight months, the longest streak since 2009, seemingly confirming Canaccord's recent finding that, quote, "it's not complacency, it's paralysis," end quote. Bearish investors say they are scaling back on these bets not because their view of the market has fundamentally changed, but because it is difficult to stick to a money-losing strategy when it seems stocks can only go up. Quote, "There seems to be an overall view that people are invincible, that things will always go up, that there are no risks, and no matter what goes on, no matter what foolishness is in play, people don't care," end quote, said Mark Cohodes, whose hedge fund focused on shorting stocks, closed in 2008. The absolute number of SPY shares short has not been this low since Q2 2007. The Wall Street Journal points out that times are tough for skeptics of the bull market. Flummoxed by the endurance of a 2017 rally that produced its 27th S&P 500 record this week, investors are backing off bets that major indexes are headed downward. The shorts have been frustrated now for quite a while, said Scott Minerd, Global Chief Investment Officer at Guggenheim Partners, which has $260 billion in assets under management. And as we detailed earlier in the week, in one sign of capitulation among the bears, stock pullbacks have been getting shorter. This year's 2.8% maximum drawdown, for now, continues a 6-year streak of drawdowns that are dramatically below the longer-term average of 14.1% drops intra-year. The journal notes if it finishes 2017 that way, it would be the second smallest decline in a calendar year over the past 60 years, according to LPL Financial, an independent brokerage and investment firm. So shorts have covered drastically. What about the longs? As Bloomberg reports, even as the S&P 500 index clawed its way to a fresh record and squeezed out a third consecutive weekly gain, signs of fading enthusiasm in U.S. stocks have become increasingly difficult to ignore. The latest can be seen in the SPDR S&P 500 Trust, the biggest exchange-traded fund tracking the U.S. equity benchmark. As of now, investors have pulled over $500 million out of the ETF in July. That puts the fund on pace for a 4th consecutive monthly outflow, which would be the longest streak since the start of the bull rally in 2009. So shorts are out, longs are fleeing. So who is buying? Simple. Recall that as we showed earlier in the week, using a Credit Suisse chart, there has been just one buyer of stocks since the financial crisis: corporations themselves. The corporate sector has been the main buyer of U.S. equities since the market low. As we have shown in the past, and as Canaccord points out again, These relentless credit flows have fueled stock buybacks, which have been the driving force for higher stock prices. And yet, despite those record buybacks, stock market volume has been anemic. Canaccord's Reynolds tied it all together last week. Those opposing forces have led to a compression of volatility. When stocks have rallied strongly, they have then been met with investor selling. When stocks sell off, the buybacks have picked up after the selling runs its course. That has been the case for more than 8 years. Those forces have led to an equity bull market that moves higher in its fits and starts, with some brief pullbacks from time to time. Given the positioning of equity investors and continued flows into credit, we do not see that pattern changing for some time. If Reynolds is right, and he may well be, there is just one catalyst that can break this chain of events: a forceful Fed intervention, which will make it all too clear that what has worked until now no longer will. To be sure, the Fed has made several very pointed statements in that regard in recent weeks. However, as has been the case for the past 8 years, it still has to actually do something to prevent what increasingly more banks are openly calling an asset bubble, and in some cases, even begging the Fed to intervene. Thank you for watching this week's Sand to Pearls Stock Market Commentary video, featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart, compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful, pleasant, relaxing weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.